The in-class, yeah, it's up there.
Oh,
And
no,
then
this midterm? Is this up there?
Yeah, I posted this,
Just
I
gonna
think I posted this weekend along with the videos.
Yeah.
Okay. So tell me when you're ready.
You can go ahead.
Okay, thank you. So the first thing is on unorthodox monetary policy. This is huge because the textbooks are being rewritten right now. Frederick of Michigan, who wrote a great book on money and banking, is going to basically put a whole chapter on negative interest rates. So let's just do a little test question. If nominal interest rates are negative, what does that do to the cost of debt and equity? If the risk-free rate turns negative, what happens to the cost of debt and equity? Using the capital asset pricing model, if the risk-free rate turns negative, what happens to the cost of the equity? Okay, what is the capital asset pricing model?
I was going to say it increases.
If the risk-free rate turns negative, what happens to the cost of the equity? It decreases. Okay, do you know can you tell me what the capital asset pricing model is? Can you tell me the risk premium, what?
Yeah, I have it in my notes.
Okay, you have to memorize it.
Okay.
Okay. So let's just talk, and let's go back and we'll get into that stuff a little bit too. You need to take notes and you need to memorize this stuff, okay? Because they're going to ask you. They'll assume you know this stuff, okay? So then when we start talking about cost of equity and CAPM and WACC and risk premium approaches and EVA, I mean when they start throwing out the acronyms, if you don't know it, you're going to get totally lost, okay? And they'll talk really, really fast and they'll send you to because you have a business degree, okay? And you got to really grade my class. And I'll get really, really frustrated later on in the semester when you don't know what a risk-free rate is, and you don't know what CAPM is, and you don't know what WACC is. These are stuff that we will have gone over like 4 or 5 times, maybe 10 times, and you still don't know it by the beginning, the middle of the semester. It becomes extremely frustrating on my part. Okay, so negative interest rates. What impact does negative interest rates have on the cost of capital? Okay, using the capital asset pricing model equation, if the risk-free rates are negative, what happens to the cost of the equity? Okay, if interest rates are negative, what happens to the cost of the debt?
Goes up.
How does it go up when the risk-free rate is negative? In the risk premium approach to determining the cost of debt, what's the very first variable in the equation? Risk-free rate. What's the very first variable in the CAPM equation? Risk-free rate. If the risk-free rate is negative, what happens to the cost of the equity and the cost of the debt? It goes down. It goes down. Here's the issue. You can study these books in their theory. In application, interest rates are negative. Over 25% of the economies globally, negative. We go into a recession, interest rates are going to turn negative. What does that do? Well, you as a bondholder will be getting negative returns. Are you better off or worse off? Worse off. This has never happened in history, okay? This has never happened in history. We're living through history, where you now have a major portion of the global economy is in a negative interest rate environment, and nobody knows what the impacts are going to be. The Federal Reserve printed $5 trillion and basically bought $5 trillion of bonds. Zero interest rate policy. We do not know what the impacts are going to be. So you as financial managers are basically operating currently in uncharted territory. It will have total impact on accounting. Will have a total impact on the value of firms. Will have an impact on the value of stocks and bonds and real estate. So when you have negative interest rates, what happens to the cost of debt and equity? It goes down. And if the discount rate is going down, what happens to the value of the stocks and the bonds? Using the perpetuity model, if the expected returns of the cost of capital go down, what happens to the valuations? Using the perpetuity model, the discount rate goes down, what happens to the valuations? Okay, so you're telling me if the discount rate goes down, the valuations go down. Is that what you're telling me?
Oh, they go up.
So if the discount rate goes down due to negative or zero interest rate policies, do the values go down?
Yes.
They do, okay. So when expected returns and discount rates and interest rates go down, valuations go down, is that correct?
No.
Are you sure? Would you bet your life on it? Would you bet the grade in this class that if interest rates go down, valuations go down? Now, this is the basic perpetuity model. We've gone over Gordon growth, we've gone over multiple, we've gone over DCF. We know that basically discount rates, when they go down, valuations go up. Okay? It's really hard for me to be able to teach the advanced applications of the class when we don't even know the fundamentals. Okay? So when discount rates go down due to low and no and negative and zero interest rates, it inflates asset prices on bank balance sheets and corporations. You're basically looking at an asset price bubble that will eventually manifest into a crash in a financial crisis. This is extremely important that you understand this, okay? Because you will probably live through a financial crisis and a recession. This is unorthodox monetary policy that's never occurred before in history. The textbooks are going to be rewritten. They're being rewritten right now because the finance models do not work in negative interest rate environments. The system does not operate in negative interest rate environments. Capitalism does not work in negative interest rate environments. Circular flow in the financial institutions do not work in negative interest rates environments. Markets and stocks and bonds do not function in negative interest rate environments. So we are on the cusp of negative interest rate environment here in the United States. It's already in Japan, it's already in Europe. If we go into negative interest rate environments, then we're going to have to teach you new financial economics, which is basically what I'm trying to do.
Do we know what's happening over there?
Yes.
And can we expect the same to happen here?
I'm not going to say that it will, but usually if a country's been operating under negative interest rate environments and basically the populace is watching their standard of living collapse, their financial institutions basically implode on themselves, and monetary and fiscal policy becoming ineffective because of these policies, then yeah, it could happen here. It could happen here. That's why I'm talking about it. Those little calculations that you're doing on the risk-free rate with the CAPM and the risk premium approach will turn the risk-free rates negative and see what happens to the costs of capital. What's created are asset price bubbles, okay? And they crash eventually. That's what happened in Japan, that's what's happening in China, that's what happened in Europe, that's what happened in Argentina and Brazil and other places across the globe. So I'm trying to use the fundamental models in the class to be able to show the application. But you have to know that if discount rates go down, values go up. If interest rates go up and cost of capital goes up, values go down. If you use the Gordon growth model, if G goes up, values go up. If G goes down, values go down. If I goes up, values go down. If I goes down, values go up. So you have to memorize the relationships or else you won't be able to analyze anything. Okay, it's the fundamental basics of the equations. That's why it's so important that you have to know how to determine the cost of debt using the risk premium approach. What's the first variable in the risk premium approach? Risk-free rate. And then what do you do? And then what do you do? You start adding on risk premiums, exactly. What's the capital loss? If I want to determine the cost of equity or the expected return on the equity, what model do I use? CAPM. CAPM, what is CAPM? capital asset pricing model. What's the capital asset pricing model? Risk-free rate plus beta. Times the,
Oh, interest rate?
yeah,
It's rate of maturity.
yeah,
Market risk,
yeah,
or market risk minus the return.
yeah. It's beta times what?
Your expected return rate?
On what?
On the market?
Expected return on the market. And what's usually the benchmark?
8 to 10%.
That is actually, it is 8 to 10%, but what is the benchmark
Oh,
that you use to measure the expected return on the market? Yeah, but what benchmark do you use? What stock market index do you use? S&P 500, excellent. You can use the S&P 500 for the expected return on the market and to calculate the beta. Okay, excellent. All right, and then how do you calculate the weighted average cost of capital? Either using the book value of the liabilities or the market value of the liabilities. Yeah, how do you calculate the weighted average cost of capital? Either using the book value of the liabilities or the market value of the liabilities. Wouldn't it be the, if it's a weighted average, wouldn't it be the weight of the equity? So the equity value, either by book or market, divided by the value of the equity and the debt, to get the weight? For both the debt and the equity? So, yeah. If the weight of the debt is 70%, then what's the weight of the equity? 30%. 30% has got to add to 100. Okay. And what model would you use to determine the cost of the debt? What model would you use to determine the cost of the debt? What model would you use to determine the cost of the equity? These are the orals. This is like the midterm orals right now. So what would you use, what model would you use to determine the cost of the equity? CAPM, excellent. What model would you use to determine the cost of the debt? We just talked about it 2 minutes ago.
Go and go?
No, you used the Gordon growth. You could rearrange it to come up with the cost of the equity. How would you rearrange this to come up with the cost of the equity? Using the Gordon growth model. You can use CAPM, but you can also use Gordon growth. How would you rearrange the equation to come up with the cost of the equity?
G equals.
We know that this is the
CFO.
cost of the equity.
Okay, so equity equals CFO divided by negative G.
Is that right?
Yeah.
algebra?
Yeah, then it switches
The algebra? So I can calculate the cost of the equity that way too. Or I can use CAPM. So how do I calculate the cost of the debt? We just talked about it. Yeah, the risk-free rate plus, and what's that model called?
Just
Risk premium. Risk premium. Do shifts in yield curves have any impact on the cost of debt and equity? Does shifts in the yield curve have any impact on the cost of the debt and the equity? Yeah, through what? Through what variable? What is it?
Through the risk-free rate.
Through the risk-free rate. Exactly. Aren't the yield curves reflections of risk-free rates? Yes or no? Yes. So if an upward shift in the yield curve occurs, because the Fed is selling the bonds, is that going to have an impact on the cost of the debt and the equity? Yeah, what direction? If the yield curve shifts up, what happens to the cost of the debt and the equity? It goes what? It goes up. And if it goes up, what happens to the value of the debt and the equity?
It goes down.
It goes down. Okay, let's do it again. If the yield curve shifts up, what happens to the cost of the debt and the equity? Okay, if the yield curve shifts up, what happens to the cost of the debt and the equity? If the yield curve shifts up, what happens to the cost of the debt and the equity?
It goes down.
If the yield curve shifts up, what happens to the cost of the debt and the equity using the risk premium and the capital asset pricing model? If the yield curve shifts up, I'm just going to keep answering.
It goes up.
Asking it goes up. And if the yield curve shifts up and the cost of the debt and the equity goes up, what happens to bond values?
Down.
They go down. Okay. If the yield curve shifts down, what happens to the cost of the debt and the equity?
They go up.
Okay, if the yield curve shifts down, what happens to the cost of the debt and the
That's
equity?
Down.
It goes down. What happens to the value of stocks and bonds? They go up. Okay. So what I'm trying to do here is to get you to understand that yield curves shifting up and down will have a direct impact on the cost of debt and equity, and will have a direct impact on the value of stocks and bonds. If the yield curve shifts up, what happens to the weighted average cost of capital for the firm? If the yield curve shifts up, what happens to the weighted average cost of capital for the firm? If the yield curve shifts up, what happens to the risk-free rate? If the yield curve shifts up, what happens to the risk-free rate?
Goes up.
Goes up. If the risk-free rate goes up, what happens to the cost of the debt and the equity?
Goes down.
If the risk-free rate goes up, what happens to the cost of the debt and the equity? Goes up. And if the cost of the debt and the equity goes up, what happens to the weighted average cost of capital? Goes up. Okay. And if the weighted average cost of capital goes up, what happens to the value of the firm? Goes down. So all valuations, and this is totally important, all valuations in stocks and bonds, and the value of firms, and the value of real estate are all tied to the yield curve. All tied to the yield curve through macroeconomic policy. So you can study in your books how to value these things, but you got to understand where the major impact on the valuations are coming from, and it's the cost of capital. It's the expected rate of return. The cost of capital for the firm is the expected rate of return for the investor. The capital asset pricing model determines the cost of equity for the firm. It also determines the expected rate of return by the equity investor. The same model. It just depends on what side you're looking at it from. So you have to feel comfortable knowing, am I talking about expected equity returns using CAPM? Am I using cost of equity from the firm standpoint? It's the same model, okay? So it's really, really important to understand these yield curves and these dynamics and what their effect is going to be on the cost of capital, because it's going to have a direct effect on the valuations. We also know that yield curves have a major impact on being able to predict stock prices and recessions. And if the yield curve inverts, what does that tell you about future inflation expectations? When the yield curve is inverted, what does that tell you about future inflation expectations?
24 months, it will recession? Or, yeah.
Using the Fisher equation, when the yield curve is inverted, is the expected inflation positive, 0, or negative?
A negative.
Negative.
Using the Fisher equation, when you have an inverted yield curve, are inflation expectations positive, 0, or negative?
Negative.
Negative. What does that tell you about aggregate demand in the economy when prices are expected to fall?
It's going down.
It's predicting a recession. Okay, it's predicting a recession. So again, the yield curves are extremely important to be able to predict recessions. 12 months, the curve inverts, stock market peaks in 12 months, or in a recession in 24. Modern portfolio theory. If you add alternative assets to your stock bond portfolio, such as cash value, life insurance, real estate, or alternative renewable energy, what does it do to the efficient frontier? If you add cash value, life insurance, alternative renewable energy,
Your risks go down.
what happens to the efficient frontier?
Your risks go down and your expected goes down as well.
Yeah, what goes down more?
Your risks.
So the portfolio standard deviation goes down more.
It's,
And what happens to the efficient frontier?
it goes closer to the cap.
Yeah, but I'm looking for terminology here. So you need to write down the language, because I'm not just making up the terminology, I'm using very specific terminology. For you, need to be able to replicate that terminology back to me, okay? So what happens is it bows out the efficient frontier. Okay? And in your in-class exams, not a lot of you showed of the bowing out of the efficient frontier. Okay? So it bows out the efficient frontier. Why does it bow out the efficient frontier? What does returns on alternative assets, are they highly correlated? Are the returns highly correlated to stocks and bonds? Or do they have low, no, or negative correlation with stocks and bonds?
They're correlated.
Do they have low, no, or negative, or are they highly correlated?
Low, no, or negative.
They're low, no, or negative. So if you add low, no, or negative correlated return assets in your stock bond portfolio, it bows out the efficient frontier. And by bowing out the efficient frontier, it will reduce the expected return on the portfolio. But it will reduce the portfolio standard deviation, or the risk of the portfolio, significantly more. So the result is the risk-adjusted rates of return in the portfolio rise, and your investors are better off. That's basically the logic that you need to understand. So it bows out the efficient frontier. The expected return goes down. The portfolio standard deviation goes down more. So your expected return on the portfolio, this goes down more than this goes down. Therefore, the risk-adjusted return goes up. And that's what investors are looking for. That's what companies are looking for when they're building out their product lines. They're looking for product lines that basically whose revenues and cash flows are somewhat correlated to the industry and the property lines that they're in, the product lines that they're in, but they're trying to diversify so that if one product line goes down, it doesn't take out the whole product line. Or if the economy goes into a recession, the whole company's impaired, all of its product lines go down. So you need cash flows or returns in your portfolio that have low, no, or negative correlation for diversification. Okay? So that's really what I was looking for there, is can you draw out the efficient frontier? Can you show the lines? Can you show 100% stock, 100% bond portfolio? Can you talk about the bowing out of the efficient frontier if you add alternatives in there? And do you know what the target portfolio allocation is for the next 30 years? Do you know what it is? The target portfolio allocation?
It's 10% of the last three things, which is real estate, renewable energy, and something else. And it's 30% of stocks and 40% of stocks and 30% bonds.
It's the other way around. 40% bonds,
40% bonds.
30% stock, 10% real estate, 10% cash value life insurance, 10% alternative renewable energy. Okay, by adding the alternatives into the portfolio, it bows out the efficient frontier and it increases the risk-adjusted rate of return, so the investors are better off. Okay. What's the perpetuity model?
Cash flow over expected
is it the interest rate that's the denominator? It's also called the discount rate. What else can it be called? Could it also be the expected return? Are we using last year's, this year's, or next year's cash flows? Next year's cash flows, okay. What's the Gordon growth model?
Cash flows over discount rate minus the growth, the expected growth rate.
Okay. Is the discount rate also considered the expected rate of return?
Yes.
Yes, okay. And the growth rate is the growth rate, what is the growth rate? What does the growth rate mean? What's the definition of the growth rate? What is the growth rate? What is G? When you use the Gordon growth model, are you assuming that the cash flows are going to be flat into perpetuity, or they're going to grow at a constant rate? They're going to grow at a constant rate. So what is G? In what?
G is what we think the growth rate is gonna be.
Of what? Of what?
The company per year.
Now, what is the G?
Refers to the percentage change of a specific variable within a time period.
Okay, what do we, in the perpetuity, I'm just gonna like grill you guys. In the perpetuity model, what's the numerator? Okay, in the Gordon
Yes.
growth model, what's the numerator?
Interest rate minus growth.
Yeah, but what's the numerator?
Numerator is CFO.
Yeah, last year, this year, or next year?
Next year.
Next year, okay. So what is G?
Growth.
In what?
From
Next
this
year.
year to next year.
Or
What is the growth rate?
The change in sales from this year to the next year.
You don't use sales.
right.
You don't use revenue. What's CFO? Cash flow. Okay, cash flow. Could EBITDA be a cash flow? Can we use earnings per share? Yep, okay. So what's G? We know the numerator is earnings per share next year. Okay, got it. We know I is the expected return on the equity or the expected return on the investment. What does G assume?
Growth of cash flow from this year to next year.
Is it this year to next year, or is it something else? Is it one period, or is it forever?
Oh, forever.
It's forever. It's into perpetuity. So G is the assumption of what the constant growth rate is, and the cash flows are forever.
So perpetuity does not involve G, and Gordon growth has for the
G,
for constant.
you got it,
Okay,
you got it.
just making sure.
Yeah, you gotta memorize that.
Yeah.
Okay, the multiple approach. How do you calculate the value of the firm or calculate the value of the stock? Using the multiple approach.
Cash flows times N.
Yeah, so do we use last year's cash flow, this year's cash flow, or next year's cash flow?
This year's cash flow?
Would you use last year's, this year, or next year's?
Isn't this about, isn't it about history, so isn't it last year?
Last year's?
I said next year.
Next year. Next year. So if you're valuing a firm or you're valuing stock, you don't use last year or this year's cash flow, you use next year's cash flow. And then what about M? Do you use last year's multiple, this year's multiple, or next year's multiple? Last year, this year, next year.
Next year.
Next year. Okay, what are the three models that you can use to come up with a multiple? And what is a multiple? Can you give me 3 examples of a multiple?
It's an P over E, which is
And what would that be called?
the multiple?
There's 3 ways of calculating the multiples. I'm asking you, do you know the 3 methods of calculating the multiples? And what multiples could you use?
You can use the perpetuity model, which is 1 over I.
That's true. You could use the perpetuity model, which is 1 over I, to get a multiple. Exactly. What's another model you could use?
According to that.
You could use Gordon growth. And what's the equation?
1 over I minus I.
1 divided by I minus G. Excellent. And then what's the last model you could use? You said P over E. What's E?
Expected.
Equity.
It's the PE multiple, price to earnings, price divided by earnings per share. Can I use that as a multiple to multiply against the EPS for next year to get the value of the firm or the stock? Yeah, okay. And then tell me about discounted cash flow methodology. Take me through the steps. If you were to ask to use the discounted cash flow method to be able to value a firm or a piece of real estate or a stock, can you walk me through the method?
This year's stock, correct?
You want to use stock, or do you want to use real estate, or do you want to use a firm? Okay, let's use a company. Walk me through the discounted cash flow method.
You're looking for the present value of the company, so you're gonna use this year's, it's gonna be the expected revenue over 1 minus the
Interest rate.
interest rate, yeah.
And then the number of year, like the exponent is the, like, year 1, year 2, year 3.
Okay, so you're going to come up with the cash flows.
And then,
What are you going to do with the cash flows? Let's say it's a 5-year holding period. And then what do you do with the cash flows? I got last year's cash flow. What do I do with it?
You're gonna project it for the next 5
Yeah.
years,
Okay,
from last
excellent.
year's.
Okay, excellent. So are you going to grow it out?
Yes.
Yeah, because you're going to grow it out over the next 5 years. If it's a 5-year holding period, do you grow it out for 5 years?
You grow it up to 5
6
years.
years.
the
Excellent.
terminal value.
6 years. Okay, so how do we get, if we grow it out 1 more year, because we do need the terminal value, right? What 2 methods could I use to get the terminal value? What 2 methods could I use?
You could grow it out for 6th year and then add it to the 5th year.
Okay, but before that, before we grow it out, do we grow out the cash flow and add it to the 5th year, or do we grow it out and calculate the terminal value? We grow it out and calculate the terminal value. What are the 2 methods that we can use to determine the terminal value? Or, no, we're doing DCF. So what are the methods that we can use to calculate the terminal value?
Gordon, multiple, and perpetuity.
Exactly,
Yeah.
Gordon, multiple, and perpetuity. Excellent.
Just like a clarifying question,
Yeah.
when we did all those like examples in class, we did, that was what we were practicing, right?
Yeah.
Okay,
Yeah.
just making sure I'm like.
Yeah, I'm just going
connecting
through it
them.
in your head. Now I'm testing you
Yeah.
orally to see if you can articulate it.
Okay.
Okay. This is kind of the oral part of it. Okay, so once you get the terminal value, what do you do with it?
Add it back to last year.
Well, let's, what do you want to do in most cases? Do you want to grow do you want to use Gordon growth or perpetuity to get the terminal value? Probably Gordon growth. If you're using perpetuity, are you more or less conservative? You're probably more conservative, right? Because if you're using Gordon growth, is your present value going to be higher or lower? Use Gordon growth to calculate the terminal value. Is your present value going to be higher or lower? It's going to be higher, right? Because you're assuming a constant growth rate in the earnings per share forever. That's going to cause the terminal value to go up and the present value to go up. Okay, I'm trying to tie this in because this is all the stuff we went through when I was doing underwriting at a lot of these companies. And there are people padding the terminal values on the back end to get the net present values and the internal rates of return high enough to get those projects accepted, and a lot of those projects failed because they were manipulating the valuations, and the board didn't even know it because the board obviously didn't have a background in finance. So they were basically hidden taken to the cleaners. Okay, so that's why we're going over this. All right. All right, so what do we do with the terminal value?
You added for the fifth year?
Yeah, where do we add it to?
The end, that's last year,
Say it,
the last year.
the last year in the holding period. Okay, excellent. And then what do we do with those cash flows? Then what do we do?
You add them all up.
Well, we have to do something first.
Divide it by, I'm gonna just use the
Well, we already did that to get the terminal value. We added the terminal value to the last year of the cash flows to the holding period. Now, do we just add those up to get the present value, or do we do something else?
Do something with the WAC,
We do what?
something with the WAC.
Well, but this is called the discounted cash flow model, so we have to do something with the cash flows. So what do we do with the cash flows?
Discount.
You discount them, okay, by what?
The discount rate?
They're called discount factors, okay? So, for example, in the fifth year, what would be the discount? What would be the equation for the discount factor? What is it? No. What would be the, what is it?
1 plus the expected return to the exponent of the number of years it is, so like the first one would be 1.08 to the first, 1.08 to the second, and so on and so forth.
Great, excellent, exactly. So you'd have to calculate the discount factors based on the discount rate. And you're right, if it was 8%, it would be 1.08 to the 1, to the 2, to the 3, to the 4, to the 5, you gotta come up with the discount factors. Then what do you do with those discount factors?
That one will have to be-
Then what do you do with the discount factors?
Take the last one, you add it to the terminal value.
No, we've already added the terminal value to the last year in the cash flow, we just calculated the discount factors, now what's the next step? Now what do we do? You should be able to follow this logic through the course notes.
Yeah.
Yeah, so what do you do after you've calculated the discount factors?
multiply by the cash flow.
What do you do to the cash flows?
Don't you just add them all up?
No, there's one more step,
You multiply them.
there's one more step.
Oh, I was gonna say you multiply the discount factors and cash flows.
You multiply the discount factors by the cash flows so you grow them out even more. What do you do with the cash flows? How do you use the discount factors? What do you do with the discount factors? How do you apply them to the cash flows to get the discounted cash flow model? What do you do with the discount factors?
Not sure.
You got the cash flows. You calculate the discount factors. Don't you divide the cash flows by the appropriate discount factors to get the discounted cash flows?
You're right.
And then what do you do with the discounted cash flows?
Then you add them together.
Then you add them up, and then you get, what's it called? No, you said it, it's not net net. What do you get when you add up the discounted cash flows? You get the,
Net present value.
do you get the net present value or the present value? You get the present value. When you subtract the cost of the construction or the cost of the acquisition, then what do you get?
Net present value.
You get net present value. If the net present value is negative,
You reject.
you reject it, okay? If you still want the project, what do you do?
Go back.
Yeah, no,
Go back. Well, yeah, you can go back, check.
Make
what
sure
do you do?
take
What's
it
the
back.
next step? There's four iterations that you have to do in order, okay? So you run it, you get a negative net present value, that's your first iteration, you either reject it or you do something else, which is the second iteration. What do you do? Yes, for a price reduction in the amount of what?
To get
What?
zero, to get to zero.
In the amount of the negative net present value. You ask for a price reduction or you reduce the cost. Okay, if you can't get price reduction or reduce the cost, what's the third iteration?
Check your map, PCF.
Go back and check your assumptions, give me the assumptions that you would audit to go back and check.
Different.
What?
If you underestimate
Yeah, you may have underestimated the growth rate, you may have, go ahead,
overestimate.
overestimated the discount rate, okay?
overestimated the return rate? Or underestimated the return rate?
That's what she said.
Oh,
Overestimated the discount rate, or the expected rate of return. Okay, so we got G, say in just the basic model, we could have underestimated the growth rate in the cash flows. We could have overestimated the
Terminal
expected
value.
return. What, did we over or underestimate the terminal value?
Underestimated.
You underestimated the terminal value, so you probably underestimated the discount rate, the terminal discount rate. Now I'm asking you, if you underestimated the terminal value, did you underestimate the terminal discount rate?
We underestimated.
Did you underestimate it or overestimate it? If the terminal value was low and you get a negative net present value, did you overestimate the terminal discount rate or underestimate the terminal discount rate?
You overestimated?
You overestimated it. You used too high of a discount rate. Okay? So if you lower the terminal discount rate, what happens to the present value?
It increases.
It increases, and what happens to the net present value?
It goes up.
It goes up also. Okay? Where else could you have made a mistake? In your terminal value calculation. I think you just said it. Somebody did. Using Gordon growth to arrive at the terminal value, we already know that there's two variables. There's the growth rate and there's the discount rate. We know that we overestimated the discount rate. Did we over or underestimate the growth rate? Do we over or underestimate the growth rate in the cash flows? We underestimated the G. Okay. So you gotta go back, you gotta look at the G, you gotta look at the terminal discount rate, you gotta look at the growth rate in the cash flows, you gotta look at the expected returns and the discount rates, and you gotta go back and you gotta look at the acquisition costs and the construction costs. And if you still can't get it to work, then what's the fourth iteration, the fourth step? You calculate the real call option. And what is the value of the real call option have to be?
Whatever that negative number was.
Yeah, whatever the negative MPV is. So if your real call option is equal to or more than the negative net present value, what is the net present value?
0.
It's 0. Would you accept or reject the project?
Except.
Yeah, excellent. Okay. Oh, that was tough, wasn't it?
Yeah.
Yeah, that's tough. Okay. Again, if you can get this, you're in. You got it. Okay. If you can get it, you're in. You got it. Okay. You got it. All right. Everything else will be easier, and then you'll know what everybody's talking about. Okay. All right. So let's talk about the tech company. We're going to buy a tech company. Cash flows last year were $200 million. Okay. We know that the growth rate using Gordon growth model is using what we're going to do is you're going to calculate 3 valuations for the firm. You're going to use perpetuity, Gordon growth, and discounted cash flow. So there's 3 valuation models. We know that the growth rate in the first year is 20%. You know, the 200, you might want to write these notes down because this is basically what's going to be on the exam, and I'm walking you through the solution right now. You know what the last year's free cash flow was $200 million. You know that the growth rate in the first year is 20%. So now you can grow that out by 200 million times 1.2 to get the next year's cash flow. Okay, you're in. Okay, now you have the first year for the TCF, you have the next year for Gordon growth, you have next year for perpetuity. We also know that the weighted average cost of capital, or the discount rate, is 22%. So if we're using perpetuity to come up with the value of the firm, what would be the equation? What would be the solution? If you're using perpetuity to come up with the value of the firm, what would be the solution? I already gave you the variables, I already gave you the solution, you just gotta do the calculation. So what's the numerator, what's the cash flow that we're gonna be using?
$240.
Okay, so it's 200,000 times 1.2 gives you what? 240. Okay, what's the discount rate you're gonna apply?
22%.
Exactly. Okay, well, there you go, there's your first valuation model. Okay, then if you were going to convert this to Gordon growth, what's the equation?
It's gonna be CFO, so cash flows over expected,
Rate of return or the WACC
minus growth rate,
minus the growth rate. Okay, so what was the cash flow?
240.
240, what was the WACC? Okay, and what's the going in growth rate?
5%.
5%. Okay, just do the math, do the calculation, boom, you get the valuation. Now let's do the discounted cash flow. So you got the base period, you got your growth rates going on for 6 years, so you're gonna have to calculate, what's the holding period?
6 years.
Well, what's the holding period? 5 years. Do you need to grow out the cash flow one more year?
So 6
Yeah.
To get what?
The terminal
Get the
value.
terminal value, exactly. Okay. And I also have the terminal. I also calculated for you the terminal growth rate and the terminal WACC. I've already done the adjustments for you. Okay, you just have to do the application to get the terminal value. So you gotta grow out the cash flows, grow it out one more year, calculate the terminal value, add it to the last year in the holding period, and then discount it back. What discount rate do we use to discount the cash flows? What rate do we use?
8%?
No. These are all new. These are all new. You gotta read the assumptions. What discount rate do we use to discount the cash flows using the DCF? Okay, what discount rate do we use to calculate the perpetuity valuation? And what discount rate do we use to value the firm using perpetuity and Gordon Growth? You just calculated. What is it? 22%. Okay, 22%. So what's the discount factor in the first year for the DCF? What's the discount factor for the first year in the discounted cash flow? What's the discount factor in the first year in the DCF model? What would be the equation? And what would be the equation for the discount factor in the second year? How do you calculate the discount factors? Okay, you grow out the cash flows, correct? And then you get a discount back. How do you calculate the discount factors? For year 1, 2, 3, 4, 5. Okay, what discount rate do you use? What is it?
22.
The 22%. How do you calculate the discount factors?
1 plus the expected, 1 plus 22%,
Yes, and then what?
and then multiply it by the year, and then like 1, 2, 3.
Do you multiply it?
Oh, no, sorry, you.
It's an exponent. Okay, so what is the discount factor in the first year?
1.22
1.22 to the what?
to the first,
To the first, and then the second year,
1.22 to the second.
and the third, and the fourth, and the fifth? Okay, excellent. So once you get the discount factors, what do?
You divide it by the first number that we got with the regular, not the regular, but the first rate.
For the cash flows?
Yeah.
Yeah, for the appropriate cash flows. And then what do you do after you get the discounted cash flows? You add them all up, and what do you get? Present value, and when you subtract the target company acquisition price, what do you get?
Net present value.
Net present value, if it's negative,
Reject.
rejected, if it's positive, accepted, okay. And if the net present value is 0, what's your internal rate of return? If the net present value is 0, what's the internal rate of return on this investment? If the net present value is 0, what's the internal rate of return? What is it?
Is it 200 million?
No, it's not in dollar terms. The net present value is 0. What's your internal rate of return?
Positive.
What is it? When the net present value is 0, the internal rate of return is your expected rate of return, 22%. If the net present value is positive, it's greater than 22%. If it's negative, it's less than 22%. So the net present value, you can interpolate the internal rate of return just from the net present value. And it doesn't really matter what it is. The question is it above or below your expected return? Or in this case, it's your cost of capital. So the next example is exactly the same. It's just you're doing a real estate investment banking example. So instead of using EBITDA, you're using net operating income. It's the same methodology. It's the same approach. You have net operating income from last year, which was 125 million. You got the going in G, the terminal G, you got gross potential rental income, which you probably don't need. Oh, here's your expected rate of return. Your going in expected return is 12%. There's your discount rate. You got the terminal expected return, which I gave you to calculate the terminal value. You already know the terminal G and the terminal value, so you can calculate it. You got the net operating income last year, and you got the growth rates going out for 6 years. And what's the holding period? 5 years. Okay. What's the cost of the development? 125 billion. So if you grow out the cash flows, calculate the terminal value, add it to the last year and the holding period, discount those back and get a present value. If you get a net present value that's negative, are you going to accept or reject it? You're going to reject it. But if you really want it, if you really want this project, what would you do?
Go back.
Hold on.
Ask for the price reduction.
Yeah.
Ask for a price reduction, but in this case, you would try to reduce the cost in the amount of the negative net present value. But if you can't do that, then what would you do? Iteration 3.
Check your
Check
work.
your
You check your assumptions, give me the assumptions. What assumptions would you
You
look at?
overestimated the I, which is.
You could have overestimated the expected return, okay, excellent.
Under the cash flows.
You underestimated the growth in the cash flows, excellent.
You underestimated the terminal value.
You underestimated the terminal value by doing what? Give me the two variables. You underestimated the terminal value by doing what? In the Gordon growth.
The future.
Overestimating the discount rate.
You overestimated the discount rate, excellent.
And the growth rate.
And what did you over or underestimate the growth rate? You underestimated the growth rate. Okay, great. Excellent. All right, you guys are getting it. Okay, then last is the stock price. So we got the earnings per share last year, which was $13. I got a going in G of 1%, a terminal G of 1%. I got the earnings per share for next year of $14. So can I got an expected return going in of 8%, and a terminal expected return of 10%. So can I take this earnings per share and divide it by the going in discount rate, or the expected return? Can I divide this expected earnings per share for next year by my expected return? Can I take the earnings per share projection for next year and divide it by my expected return?
Yeah.
And what does that give me? What model is that? If I divide the earnings per share for next year by the expected return, what model is that? Perpetuity. Okay. And if I take the expected earnings per share for next year, and I take the going in expected return, and I subtract the going in G, what model am I using? Gordon growth. Excellent. If I take next year's earnings per share and I multiply it by a P multiple of 15, Is that gonna give me a value? Yeah, what model is that? Multiple model, excellent. And then we have the earnings per share for last year. We can grow it out. And what's the holding period? 5 years. And how many years do we have to grow out the earnings per share? 6 years, excellent. And then, what are we gonna use to calculate the terminal value? Are we gonna use perpetuity or Gordon growth? We're gonna use Gordon growth. So do we have the terminal expected return? Do we have the terminal growth rate? Can we calculate the terminal value? And then what do we do with the terminal value? What do we do with the terminal value? Once we calculate it? What?
Yeah, into the 5th year.
You add it to the 5th year. Okay, and then what do we do with those cash flows?
Divide it by finance.
The discount.
No, we already calculated the terminal value, we added it to last year in the holding period. Now what do we do with those earnings per share, those cash flows?
Divided by discount.
We divide by,
This-
not the discount rate,
No discount factor.
discount factors, excellent. And then what do you get from that? How much? You get the present value. And if the present value of the stock is less than the current stock price, are you gonna buy, hold, or sell? If the present value is less than the current stock price, are you gonna buy, hold, or sell it? You're gonna sell it. You sell it, okay? And if the stock price is equal to the present value, the intrinsic value, do you buy, hold, or sell?
Hold.
You hold it. And if the present value is higher than the current stock price, are you gonna buy, hold, or sell?
Buy.
Buy, okay? And if the intrinsic value is higher than the current stock price, what other trades can you make? What other trade recommendations would you make? You did an intrinsic valuation using the discounted cash flow and the other models. You weighted them based on certain scenarios, and your weighted average intrinsic value is higher than the current stock price. What are the trade recommendations that you would make to your client? What? No, hold on, gotta start from the very beginning.
Sell margin.
This is the intrinsic value is higher than the current stock price. What are the trade recommendations? You would buy the stock, you buy a margin, buy calls,
Right futures.
hold on, and write puts. Okay, that would be the first recommendation. If the stock was a major component of an index, the stock index, what would be your recommendations on that? If we were gonna trade on the index, the indexes, what would be the recommendations?
Right forward.
Would you write the forwards or buy the forwards? You would buy the forwards.
Okay.
Buy futures,
Wait, hold on, you would buy what?
buy the forwards and then buy the futures.
Got it, what else?
Buy calls on futures.
Buy calls on futures,
Right.
and write puts on futures, so there's another 4 trades. What about the exchange traded funds? It would be the same as the stocks. Okay, so how many potential trades could we have?
12.
12. Okay, you get up potentially 12 trades. Okay. And then the last is really the evaluation matrix. What I'm looking for is that matrix where the present value is greater than the price, present value equal to the price, present value less than the price. Net present value positive, net present value equal to 0, net present value negative. Internal rate of return greater than WACC, internal rate of return equal to WACC, internal rate of return less than WACC. Break even, less than 3 years, break even equal to 3 years, break even less than 3 years. So it's basically gonna be accept, reject, reject, accept, reject, reject, accept, reject, reject, accept, reject, reject. It's all gonna be in the same.
Is this?
Yeah, exactly, that's what I'm looking for. And then I wanna see that you can do the 2 iterations, or the 4 iterations. Right, so the first is accept, reject, reject. You know, do you know how that the present value is equal, greater than the price, equal to price, less than price? MPV is positive, 0, negative. Oh, actually, when the MPV is 0, it's also accept. And when the present value and the price are the same, it's also, so it's accept, reject, reject, okay, in that order. And then if the net present value is negative, then what would be the second iteration? If the net present value was negative and you still wanted the project, you would do, you would ask
We'd
for
have to do the price for the
price
in the amount of
the negative.
net present value,
Yeah.
exactly. And then if you still had a negative, check your assumptions, and the last one, real call option. Okay, so I wanted to, that's what I'm looking for. That was tough. Okay, that was really tough. Okay. We probably won't go through this much intense stuff going forward, but I want you to memorize this stuff if you can. Okay. So these are just the nuances that took me years and years to figure out. And if you can, you're doing really well. I mean, you're picking it up. Okay. And we'll probably go over it one more time, just to make sure that it's ingrained. Okay. All right. Did you have any questions?
Yeah,
Yeah.
when the stock net present value equals 0, we hold.
Well, you usually do not use, well, you can use, let me back up. So the capital budgeting, the present value, net present value, internal, you can use that for stocks too. So if you get a present value for a stock, and then you have the price of the stock, and the net present value of the stock is negative, then you would reject it.
And if it's 0,
And you can't really get, right, can you go back to the company and say, hey, can you lower the stock price so that I can get it to work? No, you can't do that.
You can buy less stock, though.
Well, you probably have to lower your return expectations. Right? You'd have to lower your discount rate to get it to work. Or when you're doing the modeling, you might have to increase the growth rates and the earnings per share projections. Or you might have to lower the terminal discount rate to get the terminal value to go up. Or you might have to increase the growth rate and the earnings per share, into the future to get the present value high enough to get the net present value positive. So you can rework it. The only thing you can't do is go back and renegotiate the price down because it's in the marketplace. So that second iteration would be scratched out for stocks. But you could go back and audit your assumptions and manipulate those. And you could calculate a real call option too.
and what would that, like what would be in the real call for a stock?
And the real call options?
Yeah,
You would look at the historical volatility in the stock price. And the higher the historical volatility, the higher the real call option. You could assume a longer time period, which would also increase the value of the call option. And your ability to buy the stock at any point in time in the future would also increase the real call option. Okay, so applying the stock, that methodology, the iteration to stocks is slightly different than if you were doing real estate or if you were doing a valuation decision, the investment banking decisions.
Because if we were doing like a tech company, we'd have to do it within a year.
No, you would still go out probably 3 to 5 years.
Okay. But we just can't project it very well if we wanted.
Yeah, but that's why you use the perpetuity and the Gordon growth. Okay, and then what most people do, most analysts or underwriters do, is they will create multiples out of the perpetuity and the Gordon growth. And they will also use PE multiples from their experience of similar type of firms and apply those forward-looking multiples to the forward-looking cash flow to get the valuation. It's slight modification. Okay. Any other questions on that, nuances? No? Okay. We spent a little bit more time than I anticipated, but I hope it was helpful.
yeah.
So what I'm going to do is I'm just going to go through some of these. A lot of this stuff will be basically review because we went over a lot of this from the chapters. But I'll just hit on some of the high points of the chapter presentations, and then we'll finish them off on Wednesday, and then we'll break up into groups, and you'll pick some of the problems, and we'll break up into teams and solve some of the homework or the exam problems, and we'll do it like we did last time. Okay? So the capital budgeting, see that? I can't see it. And I'll just quickly walk you through these presentations. So you can use the capital budgeting just what we did, the PV, MPV, IRR analysis. If you're gonna be, you know, upgrading equipment, upgrading a building, you know, structuring a company, it's gonna cost you something, but then you're gonna have these net cash flows. And with a valuation on the back end. So then you just rerun the IRR, PV, MPV to see if it's feasible. And you can do that on renewals, replacing a piece of equipment, expanding plant equipment, and other regulatory standards that you want to take a look at. So there's the discounted cash flow methodology is used over and over again, and you can see you can use it for firms, real estate, stocks. The assumption is that these projects that you're analyzing, we have 3 companies we're looking to buy. We have 3 projects we're looking to implement, 3 product lines we're looking to do, 3 marketing programs. They're all analyzed independently, and you're looking at the net present values in those cases to see which one's going to give you the highest net present value on a positive basis. And the assumption is that time and capital is expensive, so there's always got to be some opportunity cost, either as a cost of capital or as an expected return that you're going to use to discount the cash flows. And this is your basic MPV model with net cash flows with some kind of salvage value or terminal value at the end. And then you discount it back. And if it's 0, you accept. Positive, you accept. If it's positive, your internal rate of return is higher than your expected return. So just basic calculations. And you can use this on equipment, again, companies, real estate. And here's your basic, you know, net present value model. So if you're getting the negative net present value, you know that you can reduce this to get it to 0 or positive. You can reduce this. You can grow these, or this could be higher. So you need to constantly evaluate the assumptions. Here you can do the calculation using your financial calculator because you have all the variables. And if you know what the present value is, you can calculate the internal rate of return. So by using the financial calculators, you can get the results fairly quickly along with the Excel spreadsheets. And again, I'll provide those to you. So you have those templates. And I think we beat the MPV to death. The payback period, if you know what the cost of the project is, or the acquisition, you just start subtracting the cash flows until you reach some type of break even. So here you can see we have 60,000 here and 70,000 there. We got to figure out what the break even is. Well, 70,000 was what we spent, 60,000 was what we received, 20,000. So you take the equation plus the 2 years we already know that we reached break even to get the 2.5 years. And in most cases, most projects are evaluated on a three-year break even period. Tech companies, tech investments less, and then real estate projects probably 5 to reach break even because they're just larger projects. So you have your payback period, and there's going to be each company in each industry is going to have a payback period standard. Either you need it or you don't. And in the tech industry, payback periods are looked at a lot. And then discounted payback periods, if you know what the cash flows are, then what you do is you discount them back to get a discounted cash flows. So you're not using the nominal cash flows, you're using discounted cash flows to calculate the break-even period. So it's going to take longer. And then accounting rate of return, this is basically an income return. So in real estate, you'll have the net operating income divided by the value of the property or the price of the property, which will give you the income return, which is called the accounting rate of return here. So what's my income return? And that's a hurdle rate. Firms will say, I need to hit or exceed my accounting rate of return by year 2. The sooner the better. We'll wait till year 3, but we want our income return to at least meet or exceed the hurdle rate by some given period of time.
Is this more important for like startup firms and things like that?
No, this is probably gonna be real estate and established companies. And then internal rate of return, we know that if the MPV is 0, then your internal rate of return is your discount rate. Your discount rate. And if it's positive, the internal rate of return is higher than the discount rate. If it's negative, then it's less than the discount rate. And again, if you know the inputs and you have one unknown, you can solve for it. And you can also do it through Excel. So as interest rates, and this is what's important about the yield curves, as the yield curves start to shift up and the risk-free rates start to shift up, the cost of capital and the expected returns shift up. And as you can see, at some point in time, you go from net present value positive to negative. So when the yield curves shift up significantly, projects turn net present value negative. And that's when the economy shuts down. Because people aren't investing anymore, because their rates of return are below the cost of capital. So they shut down, and the economy goes into recession. So your IRR can be greater than the weighted average cost of capital, could be greater than the equity cost of capital using CAPM, could be higher than the expected rate of return, could be higher than the discount rate. They're all interchangeable definitions. Modified internal rates of return, basically what you're doing there, you're taking the cash flows and applying the future value of interest factors to basically get the future value of the cash flows. Then you're solving, what you could do is, this is like a 0 coupon bond, where you get a value in the future and then you can calculate the IRR. So you grow out the cash flows to the terminal year and then you do a 0 coupon bond calculation to calculate the IRR. And in this case, you're just doing the manipulation. Right? So this goes over here, this goes up here, right? And then you do the division. Taking the square root to the 4th, 1 plus the MIRR, in this case it's 10.71, you subtract out the 1. And usually the modified internal rates of return are less than the internal rates of return. And so it's a very conservative approach. And again, there's going to be benchmarks. There's going to be set standards in which the company is using to evaluate these firms. The other is the profitability indexes. So it's the present value of the cash flows divided by the initial investment. So it looks like the accounting rate of return, but in this case you're taking the discounted cash flows, divided it by the initial investment. And then you can rank the projects by profitability indexes. So obviously A is going to be selected first, then B, then C, then D. So you're able to use this as another way to rank order the projects. Not just accept and reject, but let's rank them and see which ones we should do first from a rate of return standpoint, the one that's going to give us the highest contribution. And then there were some surveys done by underwriting staff and corporate finance departments to find out what methodologies they use the most when evaluating projects. And you can see that the number 1 is the internal rate of return. Then it is the net present value to make decisions, then payback period, and then accounting rate of return. It's really these two and these 3. And you're going to run all 3 of them. when you run the analysis. What am I doing on time?
14.
10 minutes?
Okay, I'll just keep
15.
going through whatever we don't get to. My computer gave me a hard
It knows it's a Wednesday or Monday.
time. It's what?
It knows it's a Monday.
Yeah, Mondays.
Yeah.
All right. So in chapter 12, we're looking at two different types of productions, automated and manual. And manual is really easy to ramp up and down production. But at some point in time, you really need to go to the automated because the demand for your product is really high. So you have to sink a bunch of money into equipment to buy the production equipment to be able to handle very large productions. So the break even is really high because you sunk a lot of money into the automated. And you can see the results. We're gonna look at EBITDA, which is revenue minus operating expenses. And operating expenses are driven by variable costs and fixed costs. And fixed costs are, you're gonna allocate the overhead of the fixed costs over time. And here's your two production scenarios. Same production, same price, but your variable costs are different. Labor is more expensive than automation. You're gonna generate revenue minus your variable costs. Fixed costs to get your free cash flow. And here's the production of manual. And at some point in time, you have to cross over into automation. Because your production, the demand for your product is just getting too high. Now, when you go to automation, your capital, the equipment, allows you to grow your cash flows, your EBITDA cash flows. The higher the production, the exponential growth in your EBITDA. But when your production falls, your EBITDA also drops exponentially. So you can see going from production of 10,000 to 8,000, the EBITDA drops 40% for automated and 22% for manual, because you can lay off employees quicker, but you already have committed capital here. So your EBITDA growth rates decelerate at a rapid rate. And there's some examples in the Excel spreadsheets too. So to be able to get that exponential growth rate in the cash flows is through what is called operating leverage. So it's your fixed costs divided by your pre-tax operating cash flows. So this is basically your equipment fixed costs. And these leverage ratios basically tell you how rapid the cash flows will increase due to the capital that you've committed to automation alone. So the operating leverage here is 1.64. So again, you're really leveraging the automation, and it's growing the cash flows. And you can also calculate it on an accounting operating leverage where you have the fixed charges divided by the accounting operating profits. And again, it's going to give you a leverage ratio. And you can really see the rate in which that automation really grows and leverages your cash flow growth rates. And then break even, you want to figure out when you're going to break even. Well, it's going to be your fixed cost, which is your equipment, divided by the price minus the variable cost. So it's your unit margins. So how long is it going to take me I've already sunk all this money into the equipment, how long is it gonna take me, based on production, to reach some type of break even? And as you can see, the break evens, because of the significantly higher fixed costs compared to labor, it's gonna take us roughly 4,000 units to break even with all that equipment compared to only 800 units from labor. But at some point in time, you're gonna have to buy more equipment because the demand for your product is gonna increase significantly. So there's gonna be some crossover point in which you're gonna have to move from labor to capital and start planning to implement and install that equipment sooner, or else you're gonna miss out on the exponential growth rates in the cash flows. And we know that EBITDA times some multiple is the value of the firm. And the break even is gonna be the fixed cost of the two alternatives and the contribution margins between the two alternatives, both capital and labor. So you can calculate different types of break-evens, and you can see in this case, using the accounting method, the break-even for the automated is 5,000 compared to 1,000 for labor. And then what you're gonna do, and this is what we've been doing too, is you're gonna be running different sensitivity analyses. And in the, that investment decision-making matrix that we talk about when we're reevaluating the assumptions, that's called sensitivity analysis. And then, excuse me, and then when we do the weights of the different valuation methodologies, when we calculated the intrinsic value using the different weights for the different valuation methods, that's called scenario analysis. And then sometimes you don't have enough data. You have enough data, but you don't have enough data. What you'll do is you'll use simulation. And you accounting majors and marketing research majors and also social media majors, finance majors, ops majors. You'll probably at some point use some sophisticated simulation analysis, which is called Monte Carlo analysis. Will you be taking samples from the data and replacing it and doing it like 5,000 times to basically replicate data. You'll be replicating internal rates of return and net present values, and maybe stock prices. So simulation is extremely powerful. Did you use this in your ops class at all? Were you guys doing any simulation, any Monte Carlo?
Not yet.
No. You may not get it until grad school, but in some schools they're already using the simulation. So you may want to look into it so you know how to use it, so that when somebody talks about Monte Carlo simulation, that you at least know what it is. Okay. How much time do we have?
5 minutes.
5 minutes.
5 minutes. Let's see how many slides I have on this. Why don't we hold off on this one so I can do the rest of them? Because I thought that was a pretty exhaustive class.
Yeah.
Thank you, everybody. If you have any questions, don't hesitate to call me, ask me. The exam's already up there. Some of it's already there that's already done. There's videos, review.
The first thing we know, that was take-home test number 2? Or-
Yeah, that was the midterm. Yeah, that's what we're doing. If you get stuck on anything, you may want to make an attempt at it and then have them check it. Yeah, it's already up there. It's up on the